Okay, we've begun recording, and I'm Tim Quast with Market Structure Edge, along with Brian Wilson from our market strategist, and Brent Slava from Stock Trader Network. And we collaborate. We encourage you to use Stock Trader Network. I'm on there periodically, and if you're listening in from there, Brent can feed questions. If you want us to do some ticker time or whatever, we will attempt to do that. We'll see how it goes. Anyway, it's August 20, 2026, and this is the live Edge discussion. We appreciate you joining us today. Okay, so since I was out last week, leaving Brian with the duties, that means I get the short straw to go first. So this is, if you need, you need to hit a restroom, something like that. Now's the time to do that. But before Brian gets to his segment, it's a long running joke, right? So anyway, I'm gonna let me tee up here. I've got four things that I want to talk about, and they shouldn't take long. They wouldn't take an ordinary person long. I'm verbose, so it'll take a little longer. But right at the top, so John Laxton, if you're here, you asked about this, so I thought we'll use this as a kickoff. So if you haven't done this before, by the way, please ask us questions. That's what we want to help you use the platform. The platform is built on demand and supply. These, weird looking graphs of green and gray, or whatever color they appear to be to you, are demand and supply. So demand is an algorithm that meters trade execution data. We want to see all of the money, all of the volume, and see what it's doing, and isolate down to, look at individual stocks or portfolios or sectors or the whole market and see what they're doing. Here in our ideas portfolios, up here is the same stuff, just has probabilities built in. We look for things with strong demand and declining supply. This will give us a bigger move than this, and you can see why, right? Low volatility isn't going to give you a lot, but there's a lot less risk in these. And so, you look for demand and supply to be moving away from each other. And we say, generally, demand trumps supply. And that was, John, that was your question. You said, well, what does that mean and why? So let me give you some examples and why this is true. I'm going to pull up several tickers, but I'm going to scroll down to a portfolio that I keep on my desktop, which you can do too. I call it mega cap rising, and it's because it's looking for mega caps with strong demand and also rising supply. I mean, those things will have to resell. I'll explain which thing trumps, and right there it will illustrate it. I mean, if you were to rank the two, you would take demand over supply, because why? Supply has a very short window. Supply is short volume, not short interest. Reg SHO, Rule 201 data. Half the volume is long and half is short. Really, that's all trades are going to be one or the other. When they're reported into the tape, into FINRA, which manages the trade reporting facilities for the volume that occurs off of exchanges, half the volume is at exchanges. Half of it is at broker-dealers regulated as alternative trading systems. That's why the exchanges want to trade 24 hours a day. They've lost half their market share. And so they want to get it back. But when the trades are reported, they're going to be marked long or short. Were these shares borrowed by the customer or the broker-dealer, or are they owned? And a great deal of it is borrowed because so much of the volume comes from market makers. But if I were to just look at, let's take, a case in point here. How about Moderna? So Moderna somehow, despite volatility girders, goes up 177% yesterday. Only one behavior was responsible for that: Citadel et al. I'm using them as like Kleenex. It's a type. But Moderna had it too. Moderna had rising supply and rising demand, and demand trumps supply. It's a great illustration. There's excess supply coming from stock that really doesn't exist. It's shorted, but there are enough buyers that all of that excess stock gets absorbed, and the stock could have a propensity to rise. And of course, it skyrockets here. And then you see a lot of this is a problem when prices and short volume move opposite. That is a short squeeze. They don't happen very often, but it sure happened here, where machines, people were forced to cover. But with this condition, up to this point anyway, and isn't it interesting? Somebody's already knew. So that if you were watching modernity, you say, wow, it hit the ceiling. And then here on the 14th, supply actually declined. So it's a great illustration of the very things that we want to look for. Now, here might seem to be something contradictory. We could look at Walmart. Having a tough day today, should never report earnings during options expirations. And I've told them that. You shouldn't do that. But here you have rising demand and rising supply. So why would the stock plunge? Well, during options expirations, there's a very significant risk that the general principle might be subordinated to a specific outcome, where derivatives get marked to zero, and it can take a bunch of your market cap off. If let's say that 17% of Walmart's market cap ties to derivatives, rights without obligations, and then immediately machines change the price before the market opens, and so that stuff that is renewing today gets marked to zero. So it might be a slight exception. Let's look at Marvell. I'm just giving you, a basic principle and then some illustrations, some examples to support it. Here, supply and demand are both rising. Which thing wins? Well, demand generally wins if those conditions exist. If you have very strong demand, probably it is even in part a result of increasing supply. And you'd say, well, Tim, then isn't this a contradiction? Don't you buy diverging demand and supply? Absolutely. I mean, that is a more sustainable condition. I'm just saying that if you have these conditions, probably demand will trump supply. And the central tendency bears that out. We look at enough data, we will find that to be true. A couple more, and then we'll move on to the next topic. SpaceX. Interestingly, the contrarian model picked that up back in here. It's gotten rid of it, but it was pretty good. Here, demand and supply diverged, right? That's a very good signal. Now, demand is strong and supply is rising, and price is beginning to deteriorate. I'm just giving you looks from different angles. The optimal condition is the divergence condition. When that doesn't exist, which thing might trump? Well, I'll come back to say that demand generally does. Now, you'd say the last couple of days, SpaceX has deteriorated, and what would you point to? Well, you'd point to the high supply side, but generally the principle holds. And one more, and then we'll move on. ExxonMobil, you can always look at this. If you're prioritizing, you say, I always take demand supply divergences first. If there's stock has strong demand and strong supply, more risk, but probably demand will win that tug of war. Here, it's beginning to deteriorate. You could actually say demand and supply diverged here, right? But now supply is rising and demand's rising. It has just hit the Hicks rule of getting to 10, but it's not the Hicks rule, because the Hicks rule says we want 10 and declining supply. That will have a higher probability of producing a return. But if you took the average over these 3 days, ExxonMobil is up a little bit. That's what we mean, though. If we had to, the math, a lot of math bears out that generally speaking, demand will trump supply. Now, number two, context. When you look around, see what the market's, I haven't looked at it here. Now the Dow's down 635 points. And, the discussion will be, well, this effort by the Treasury to exchange short-term notes and paper for long-term obligations to try to bring the long end of the curve down in bonds. And I think Brian may talk more about that. It's not my area of expertise, but certainly I understand how those things work. That's not working and that's why stocks are down today. No, it's not. It's not why. It is context. Index options expire today. Yesterday, VIX options reset. And the market was pretty strong because there is, interestingly, a lot of money that wants to be, I don't know, is it short or long volatility? There's a lot that will drive the underlying assets. And so it's not surprising that the market might buck what we think is the trend when that condition exists. But now index options expire tomorrow, single stock options expire Monday. The new series begins trading. Well, is it going to be the same demand? Probably not after today. If we have two volatile days, Monday also could be. I'm not saying it will be. Maybe everything resets, but it is context. We say, there's broad sentiment. What is the broad market doing? What is context? What is occurring in the cadence and calendar of the market? Always beware of that. And then you trade divergences. And I'll look very quickly at this. This is an interesting condition where we have been, call it at the red line for 11 days. It's unusual. That gets into the higher ranks of periods of time where that has occurred. But it also makes it difficult for the market to rise. If you have the same persistent demand right at the red line, right at the top, how will the market post gains? Well, the gains would, in this instance, generally require this, a decline on the supply side. You get a decline on the supply side when there's strong demand, and you can get an upward bias in the market until the condition changes. When they're running along at the same level, it's really an interesting condition when you think about how the market works. A great deal of what occurs in the market is arbitrage. You've got stocks that underpin ETFs, far and away the big investment vehicle of the day. They trump every other form of fund flows, $100 billion a month to the good. Almost 3 trillion of creations and redemptions every month in ETFs. This is what we're all choosing to do. It's where all the money is going. Then you have associated options on the stocks and the ETFs, and there are futures as well. And so you want to be long short in that mix. Well, what do you do if they're the same? Which side of the trade do you take? This is the thing that we look at. We say that becomes concerning because if you're an automated trader trying to figure out, do I go long the ETF and short the basket and I buy some calls because I think the general bias is up and I can get a yield? What do I do if I can't figure out which side of the trade to be on? This is what you get. This is a manifestation of that condition. It is a signal that tells us that there is a mathematical conflict. What's the word I'm looking for? Dissonance in the data, and it could go either way. Now, if order is restored, it's unlikely that this doesn't have some kind of dip because it just doesn't stay there. It tends to be a great outlier. It stayed there as long as 36 days before. So we can track that. You could track it. You could download this data and look at, it's very easy to analyze that data and say to, Copilot, how long, give me the rank for me, the longest periods at which demand has been 6.0 or better, longest to shortest. You could do that over any period of time. And then you could have, well, what happens on the supply side? What does price do? All these things are, it's not that difficult to figure out, but that is a condition that probably deteriorates. So unless this deteriorates too, there's risk in the markets. That just, that's why I come back to the importance of context. The last thing very quickly I want to cover are the model portfolios. We want to look at those each week. So I will shift to this. So we run 5 models right now. Focus passive, we haven't shifted away from, but you look at it and say, well, it's not really delivering any returns. It's very similar to, this is, back to January, so year to date, had tremendous performance into June 1. Everything changed. And so it hasn't been a great performer since. If you're buying it here, maybe you're up, but not by a whole lot. And this is SPY. SPY has performed similarly. And if this is a proxy for what passive investors are encountering, it could begin to weigh on the customers who have asset allocation models and say, well, I'm not getting any return out of that. I don't know, but it's difficult to say, well, should we be using that? That's why we run other portfolios. So you can always look at other horses and say, well, maybe there's another horse that's better to ride at a given time. I'll move over to the momentum portfolio. We've run this for a long time since we built these. And it's been fine in August, but it's come down some. It's generally, it's certainly outperformed SPY since May, but it's volatile. So is it the best horse? I'll tell you the one that I think right now is the best. At Focus Fives, it's done a really good job. It's not the kind of returns that those have had, but in terms of being very stable, because it's looking for stocks that are at 5 and delivering performance that since June 1 has handily outperformed SPY. This has been very good. But notice that none of the trends look great, right? None of those say, well, the trend is up in performance. And I note those things. It tells us about the state of the market. Here, this is a smaller graph. I would argue that the very best thing right now is the Focus Mega Caps portfolio. It is not dramatically outperforming the SPY. This is a year-to-date look. But in terms of just generally holding it together pretty well, it's up 17%. And look what it owns. I mean, it's going to find big stuff. You say, well, I can figure that out. But it's mathematical. It is not given to human emotion. It just looks for the conditions that are good for when to own those things. Takes the thinking out of it. That right now, to me, is the best one. And we know if these things hold up, the market's probably fine. The last one here, and I'll hand the baton, Brian, is our Focus Contrarian. It's looking for junk that is so junky, it might improve, but it's not going to own much. It's almost like it's kind of fun to do. If you looked at from May 1 to present, it has been really strong, right? It's because it looks for things where money might go. And so money has gone there. I can't look at this and say, well, the trend is very good. But if you're not committing much to it, and it will continually rebalance, it's not a bad thing. Right now, all it owns is these 3 stocks, which are, I mean, who would pick those? So, but it's delivered really good returns over the since May 1. But it's unusual. I'll tell you, we're not advocating it. We're saying we look for what the signals that the market might give to us. Money will do those kind of things. Like, I mean, you could look at this Accenture. Did terribly until short volume dropped below 20%, and we crossed from Q2 to Q3. All of a sudden, it took off. I mean, why did that occur? It's not fundamental. It's money saying, okay, I'm going to use this because it's a large cap, it's a mega cap, and put it in a portfolio. Those are interesting features of the market. Okay, I'm finished. Brian, over to you.
Tim, real quick question. Do you mind sharing your mega cap rising, the criteria that you use for that one?
Yeah, sure. And it's in there, by the way. You can always see the criteria, right? So the criteria will always be on the criteria tab. They will be generally like what you have at Edge. We can do a little bit more nuanced stuff with the software that we use for that. But the criteria.
Sorry, Tim, for your individual portfolio, the mega cap rising.
Yeah, I meant to do that too, and I just scatterbrained. Okay, so here it is. I'll show you. So the mega cap rising says look for mega caps with sentiment greater or equal to 7 and a trend that is not equal to down. It means it could be flat, and the short volume 5-day trend that is up. That's it. That's what it's looking for. And it's it tells you where there is insufficient underlying supply, and so artificial supply gets created. It's not sustainable, but it's an interesting thing to look at. I like to see, well, where's the money going? Because it's probably a signal. It doesn't mean you get great moves. Divergence creates great moves. Excess supply tells you where money's going, though, because their liquidity is so bad in the market. There's not much of it. Okay, Brian, I chewed up a bunch of your time. Apologies.
Oh, no worries. No worries. And we'll have a couple, maybe, Tim, you can look in the chat line for a couple of tickers maybe to look up here in a few minutes. I wanted to just touch base on a topic that I discussed last Thursday, and I think it's important to keep in mind. I did mention it at last Thursday's meeting. I'm going to go back there again because it is lurking behind the scenes, and I'll start with one of our reports on the Modern IR side. So what this is, obviously you're familiar with the SPY. we can look at this report, and you'll see on the market desk notes, I'll share intraday volatility, and this is where I'm getting this information from. The point here, you can see it very clearly. 5-day intraday volatility, SPY 50 basis points, the norms being 1%. And I did an exercise last week where I looked at the market when intraday volatility is 50 basis points lighter than norms. So in other words, what happens after we have those episodes? Well, on average, we go about 2 weeks before the market declines by 1% or more. And actually, on average, it's happened 4 times during the last year. And recognize this as a 1-year exercise, but it's happened 4 times, and the average decline is 1.75%. So it can be significant at times. That's part of the risk that's out there. Why does this become a risk? And I'll circle back to that edge note. And then Tim kind of mentioned part of this already. We're getting a shrinking of arbitrage opportunities. We're getting market makers that are hedging less aggressively. We're getting that compression of intraday volatility. To a certain extent, investors are becoming confident and complacent. Risk premia is declining. And what happens as a summary is the market just becomes fragile to an unexpected shock. That 5-day number was 50 basis points a week ago. It's still there right now. So that risk has not gone away. So I just wanted to mention that. What does that mean for you as a trader? Well, be aware that it's out there. Perhaps that affects your position sizes. Perhaps you might want to look into some type of hedge. I bought UVXY a few days ago, and I've added to it a couple of times. It's not normally something that you want to hold overnight, but when the market becomes this way, I will sometimes hold it for a week or two, just as a market hedge. Speaking of the market and volatility, let's go take a peek at the daily trading ideas for a moment, and just a consideration here for your trading, especially when we get to important events like options expiration. You look at, and I normally just sort them by 100%, but it also sorts it by volatility at the same time. This is potential movement from lows to highs during a given trading day. And if you look the last couple of days, we've had some moves in the momentum portfolio where they've taken up all of the volatility to the downside. So that's the potential risk. It's a potential risk at all times, really, but especially when we come up on events like expirations. How can you deal with that? Well, one, recognize that it's there. It tells you very clearly what the average volatility is. You can choose not to trade the high volatility names. Let's say you don't want that much exposure. Just make your way down the list. Choose something that you're more comfortable with. 5-6%, whatever it might be. But just recognize that yes, these stocks, they're momentum stocks for a reason. They can move higher by that amount. They can move lower by that amount as well. And just be prepared for that potential risk. If you go into MXO, if you go into SanDisk, be aware that the risk is there. Maybe you want to reduce position sizes, or when you're coming into expirations itself, maybe you just don't trade, for a few days, knowing that there's other things that's going on in the market. One rule, and it's just my rule, but one rule that I adhere to when I'm trading in the daily names here, I don't trade from Friday going into Monday, not a normal week, but when we conclude expirations and we move into next week, it's a point in time. So expiration has concluded. Monday, we're going to shift our attention to the September series. Will SanDisk have that same exact interest in the September series? I don't know. Will CoreWeave have the same exact interest? Not sure. So those are considerations, and it's just my rule, but I won't trade Friday going into Monday because of that, because we're we're going through a transitional period. I did mention today, in terms of tracking the broad market, or excuse me, the broad market, the bond market, can we track that with edge data? And I'm not a bond expert by any stretch of the imagination. Tim is much better at it than I am. But when we look at, what can we track? What is a system telling us? Short volume is one of those things that we can track. So borrowed shares in the marketplace. And if we look at what was going on, especially kind of right through here, so when bond yields really started to spike, what was happening with short volume? Really nothing. Were people hedging aggressively? Were they short selling? No, not really. So that's where I came up with the conclusion in today's note that market participants just aren't doing very much from a bond yield perspective. Now, maybe they have it wrong. Could certainly be the case. Are other things going on in the market besides short volume that will give us clues to what's going on in the bond market? Of course, but this is one clue that you can look at from a market structure perspective, from an edge perspective, to see how equity participants are viewing those items that are happening in the market. Tim, did you want to look at a couple of individual cases before we move to the path ahead?
Sorry, I was muted. Yeah, we can do that. Let's look at Brent for Aero Systems, I think it's called. I mean, that thing's been around a long time, and spent a lot of time at 2. So how would you? It's harder with stocks that are lower priced generally, and certainly not lower priced anymore. But the whole demand supply, principles continue to apply. If you have rising demand and declining supply, you're going to get a bounce out of it, and you leave when supply rises. Huge drop in short volume here. That would have been in March, April. Strong demand. Where it is now with this big drop, and demand still at 10 and supply falling, that's such a big move. It's risky when it moves so much more than its volatility. And you can always check the volatility. You can put it in a portfolio. Like, what you do is you add it to a portfolio, and then you can look at the other metrics, how much its market cap, its volatility, and so on. Pretty easy to do. I, at this point, would be wary. Even though the demand is strong, I mean, we can go back and look at what has happened historically when these same conditions have existed, and it looks kind of risky to me. But those principles will apply. Okay, what was the other thing? And BJ's. Let's look at BJ's. I sent a note on that. I mean, this is almost like a focused contrarian, where it's so bad. The supply has risen near to 60%. Demand has declined all the way down to 1.8. The probability, that's a strong convergence. That's a risky play. So unless it was a contrarian situation, and we do sometimes look for that, it got to 1 and supply is way up. What is the probability that it might go higher? Well, at the other side of options expirations, if they have earnings, boy, you wouldn't take much risk on it, and its volatility is 2.5%. So if you were to do it on that basis, you would want to have a stop probably down 3%, 3.5%. So because the odds are it's not going to perform well, but if it did, it could really move, because these two things could move off opposite each other. Not what I would choose to do. Just that's too much risk to me. Okay. Let's see. Anesh, you asked about Merck. I mean, they both look good, right? Merck, kind of similar to Moderna. You could see that there was some expectation. There's been this strong slide on the supply side. Right here, you have demand rising. Supply takes a nice dip just ahead of that. It's just basically in line with trend. You would look at that and say, well, there's a probability that could move, right? I wouldn't have thought it would be 12 or 13%, but you'd look at that and say the demand supply equation that would project gains there, and they both have that. Okay, good enough. We're a couple minutes over, but not too bad. I'll be here. I think I'll be here next week. You too, Brian. We'll see where we are out the other side of options expirations.